clearly there seemed to be a bottom in place, which has actually happened in the last 2 days. And now some consolidation is setting in. Technical guys are saying that after a day or two of consolidation, we may actually start seeing resumption of rally once again. But financial is a space to watch out for. And I have Vinay Sharma of Reliance and, of course, now Nippon Asset Management joining me on the show now. Vinay, tell me, how is the financial space looking? It has also been a beneficiary of the tax cuts which have been announced. How is the space got re-rated in the last 2 days in your view before I come to specific segments of the financial space?
So while this is true that the rally has been fast and furious over the past 2-3 days, but if you look at it just from the theoretical perspective, banks have been one of the biggest beneficiary of the tax cut move by the government. What it does is their sustainable ROEs goes up by a few percentage points, and to that extent, because banks are largely valued on the price to book ROE multiples, their theoretical price to book also goes up in tandem. So therefore, while the re-rating has been pretty sharp, we believe that there is still a few legs to go, and the fundamentals of the sector have been continuously improving over the past few quarters, and that is likely to continue, and that is the more important reason for the sector to continue to re-rate. We still believe that in the current environment, banks will continue to gain market share over most of the other financial intermediaries, and this market share is likely to be sustainable and over the medium term. Add to that fact that if this tax rate cut leads to any impetus in investment growth, or if it leads to a kickstart of manufacturing or investment cycle in India, that could be an added bonus for the sector. So overall, while the move has been sharp, we still believe there are more legs to go to the banking re-rating story.
Right. Vinay, I would want your calls on large corporate public sector banks, not specific, but I'm just taking example, the likes of top 4 public sector banks, SBI, BOB, PNB, Canara Bank, kind of the likes. Especially if one were to compare the kind of pre-provisioning profit these guys are making to the market cap the street is actually giving them. Also in light of where the NPA cycle lies, does it make some case to look at them in terms of valuation of the growth and the growth prospects on a case-to-case basis? But do you think there's merit in this argument?
So I completely agree with you that because of the experience of the past few years where India went through a severe corporate NPL cycle, the valuations of these banks have taken a huge beating, and as the corporate cycle, credit cycle improves, as we see provisioning burden go down on these banks, we would tend to believe that that these banks will also see a re-rating incommensurate with the improvement in credit cycle. That is, credit cycle is one of the most important factors that drives banks' valuation across the globe, and India is unlikely to be any different. Also added that to the fact that now the sector has seen various improvements along with the recent merger announcements, and the way banking sector is evolving globally, the big banks are only getting bigger, and market share is getting concentrated. With the technology changes, with the amount of HR talent requirement increasing, I think there is a case for these banks to re-rate as and when we see provisioning burden going down. Because today, as you said correctly, what is happening is that while the pre-provisioning profits are good, that doesn't translate into actual profits at the PBT and the PAT level because of the provisioning requirement. And as in when that normalizes, I think these banks will see some bit of re-rating. Also, in the past few years, the majority of the beating has been in the space has been taken by banks which were corporate heavy and where the asset quality cycle turned unfavorable. Now, as the cycle reverses, we believe that there would be improvement in valuation multiples of most of these banks, and as you said correctly, the large public sector banks and the large private sector banks, which are more corporate heavy, should benefit from that.
Right. Vinay, let's shift focus and talk about, pure retail-centric banks like the HDFC banks of the world, Kotak Bank. These two are also at fresh lifetime highs, but they have traditionally been called expensive. Recently, the commentary from HDFC Bank seemed to be suggesting that, the confidence of the bank in growth continues. They are going to, go very aggressive from here on with the help of digital, etc. And growth, which started showing in one of the quarters, is perhaps not it's only a temporary factor. What's your stance in these retail-centric, relatively expensive, but very, stable kind of banks?
So when it comes to retail banks and retail entities in India, this story has been very healthy for past few years. These banks have gained market share at the expense of some of the other large banks because the other banks were suffering from some of the asset quality problems that as we discussed earlier. And retail credit was what was driving the system credit growth. While we might see a little bit of slowdown in retail credit growth, but still the credit cycle seems very healthy. The fundamental change of CIBIL coming in a few years back has completely transformed the fundamentals of the credit cycle in India. And today, most of the retail banks have much healthier balance sheets. Plus, this tax rate cut has actually benefited them more than most of the other financial entities because they were full tax-paying entities, as well as they had very little of those deferred tax liabilities which some of the corporate sector banks have. So to that extent, they have been a big beneficiary of the recent move. But from a valuation perspective, today we like the large corporate heavy banks more than the retail sector banks, despite cycle being fairly stable for the retail sector banks, because we believe the kind of valuation re-rating that the corporate sector banks can see could be much better than what the retail sector banks can have. And as you said, retail sector banks in India are some of the most expensive names. Anyway, when you compare them to their emerging market peers or the developed market peers, they have always been expensive, and rightly so. But we see more scope of re-rating in corporate sector banks compared to retail sector banks today.
Mm-hmm. Vinay, how are you analyzing the NBFC space, both housing finance and the overall NBFC space? There have been the big ones, say Bajaj Finances of the world, Chola Sundarams, the conservative big ones, which have not only withered the storm, have done capital raising. Even L&T Finance did successive capital raising. And then there are some of them like Piramal, Edelweiss, etc., who had a tilt towards real estate, have gone through their own rough patch in terms of risk arising from real estate lending, etc. But now the system is getting more well-oiled in terms of availability of liquidity. And these guys have also smartened up and reduced their exposure to real estate books. How are you analyzing the entire gamut of NBFCs now?
So I think you partially answered the question yourself when you said that the market in past few quarters has basically painted the entire NBFC space with one stroke. There is a need for differentiation between various kinds of NBFCs. If you see NBFCs which have gone through the rough patch in the past few quarters are the ones which either had lent rapidly to one specific sector over the past few years, or are the ones which had a weaker borrowing profile and lesser access to public deposits compared to some of their counterparts. As we move forward, we believe that you will see some of the stronger NBFCs, some of the NBFCs which have sustainable competitive moat, which have access to deposits, and which have a much stronger balance sheet. They are likely to gain market share over the medium term, and therefore markets would start differentiating between various segments of NBFCs. India has a gamut of NBFCs. they should not be actually painted with the same stroke. Having said that, I think some of the sectors that you mentioned, specifically real estate, we believe fundamentals there would be weak for some more time, and therefore one has to be very selective in the space. But in a nutshell, we are starting to like a few names in the NBFC space, especially given that their valuations have taken a severe beating over the past few quarters. We would still like to stay away from real estate linked entities, but one should not equate real estate related NBFCs or wholesale NBFCs with the housing sector NBFCs. These are two very different kind of entities. So in a nutshell, the answer still remains that we are selective. We are now starting to get optimistic about a few segments in NBFCs, specifically the consumer related ones.